Ona.
Welcome to TikTok Talkers, September 25th, 2023, Monday night, 9:41 p.m. Your stock market mentor here, Godric. I got the option chain behind us, AMD. AMD is one of those good stocks, one of those big stocks that are pretty popular. A lot of investors, a lot of traders. A lot of traders in AMD symbol. Look it up. Advanced Micro Devices. We're going to talk about that stock today and some other stocks. Some other great stocks. You guys saving money? You have your account at TD Ameritrade? Ready to do some options tonight? Some trading, some investing? Okay. AMD. Advanced Micro Devices. So pull up your account and click on, let's say, fundamentals, and type AMD. Can you hear me? I'm going to load my other account to make sure it's working. Bear with me. Your stock market mentor here, Godric. We're looking at AMD stock right now. Advanced Micro Devices. Symbol AMD. September 25th, 2023. Monday night. We're going to do Monday night stock market. Before you look at some stocks, go ahead and put a comment if you want me to check your stock for you. Don't be mad if I say it's trash, because, you know, that's what I do. I evaluate. I can assess for you. Okay. Testing. Anybody have a comment for me before we start? Welcome. I'm doing stock market Monday nights for about hour and a half. Okay, so on AMD, we're going to click on fundamentals and tell you what we get. Advanced Micro Devices Incorporated, a global semiconductor company. The company operates through 4 segments: data center, client, gaming, and embedded. The data center segment includes server central processing units, CPUs, and graphics processing units, GPUs. data processing units, DPUs, field programmable gate arrays, FPGAs, an adaptive system on a chip, SoC. Products for data centers. The client segment includes CPUs, accelerated processing units, APUs, the intricate microprocessors and GPUs, APUs, the chipsets for desktop and notebook personal computers. The gaming segment includes discrete GPUs, semi-custom SoC product and development services. The embedded segment, which primarily includes embedded CPUs and GPUs, FPGAs, and mobile APUs, include AMD Ryzen and AMD Athlon mobile processors for the commercial and consumer markets. So they do computers. Stock price $97.38, up $1.18 today. Volume, well, the 10-day average volume is 50.7 million. And that's great because that indicates there's a lot of investors, a lot of traders in there. And those traders will buy the stock if it dips, if it corrects. And that'll bring the price back up. And that's going to save your ass. That's all the difference between a big company with a lot of volume and a small no-name company nobody knows about. When that stock dips, there'll be people to support the stock to buy it back up. And it makes all the difference. Okay, so I have, if you pull up the chart, I like to do a 10-year chart. I have something like $3 a share 10 years ago. And now it's, let's say, $100. So 33-fold, something like that. 33 times your money. That's the kind of return that I want to see in an investment. I want to see, going up 30 times, 20 times, 50 times your investment. Okay. A lot of these stocks have gone up 20, 30, 40, 50, 100 times the investment. And that's important because over time you want to make money. You don't want to lose money. You want to make money over time. And right now it's trading about $97, up $1 today. So we're going to look at the, I have the option chain behind you. Option chain is, for every stock, every big stock like Coca-Cola, AMD, Tesla, there's like 1,000 options. And we use these options for different things. The idea is to use them for your benefit. In this case, writing covered calls. Also, writing naked puts. Same idea. They're both long positions. One is having the shares, 100 shares on the cover call, agreeing to sell it, in this case for a higher price, every month, getting a return on that trade, getting a return, a premium for writing that option. So you have the shares. When you write the option, you create the option. And in this case, it's like 3% a month. Let me, I have it here for you, but I'm in the way. I'm going to pull out for you here. Since it's September, we go to October. And if it's October, we go to November. November, we go to December. But we trade every month or so, between like 3 and 7 weeks. Between 3 and 7 weeks is a good trade. Give me some likes, guys. Appreciate it. Get some people in here. Okay, so if you look at the option chain for next month, October, you'll see 100 strike, which is to say we buy the shares at 97.38. So we have $9,738 invested. Okay, let's say 10 grand. We buy 100 shares of AMD at the market, and we write the cover call for next. We write the cover call for October, which is next month, and for the 100 strike, which I'm gonna explain it right now. You're gonna get 325 by 335. So 325 by 335. That's the bid ask. The bid is the one we're discussing. The bid is the one we get paid when we write the cover call. So bid 325, which means we get $3.25 per share for writing the cover call for next month on AMD. Now, that doesn't sound like a lot, but if you have 100 shares, that's $325. $325. And we can do this trade every month. Okay. Give me some likes, guys, if you want to put a question in there. I'll try to get to it. That's $325. And that pays for food. It might pay for your car note, part of your rent, maybe a utility bill. So let's do the math. Okay, so get your calculators out. I got my calculator here. What you do, type 3.25, which is the price that the option chain gives you. It's actually right here, right there, 325 by 335 at 100 strike. 325 divided by the share price, which is your investment, 97.38 equals 3.337% return. Look at that. 3.34, because we round up, percent return. Or you can say 3.3. 3.3. That's a great return for a month. I'll tell you right now, not every stock is eligible for cover calls or even options, but AMD is one of them. AMD is going to get you 3.3% return on a cover call per month, probably more if it's around 3 to 4%, because I've been doing this trade. But 3.3 is a really nice return in a general sense for an investment. So the 10K, your 9.7K is going to bring in $325 in this case, which is 3.3% return on the cover call. So again, for the option chain, we're looking at agreeing to sell it for $100. And that means that if the stock goes up, we're going to make even more money, because if the stock goes to 100 and it passes 100, it will sell for 100. So I buy it at 97.38, right? CC, cover call. I'm writing in my journal here. I'm taking notes for you guys. At 100 or more, but it's going to be 100 when you put the strike 100. You're going to get 325 for that. But you're going to get also the share growth from 97.38 to 100. Let's do the math for you right here. It's going to be 262. 262. So you have $262 more dollars eligible if the stock goes up, breaks 100. Your cover call will take effect, and you'll sell at 100. So you'll get 262 more. So let's add the 262 plus 325, which is the premium. The 262 is called share growth, SG. The 325 is the cover call premium. Just put CC. So that's 78587. So let's do the maximum. What could happen? The stock can go up by next month. 587 divided by 97. That's the premium. That's together, both of them put together. Divided by 97.38. 6.027%. So let's say 6.0% return. That's the maximum. So that's a great return for 1 month. That only happens if the stock breaks 100. What often happens, the stock kind of stays the same price. goes up, goes down, doesn't break 100, and you end up getting just your premium, which is back to 3.3% or 325, which is great. That trade expires. They say expires worthless, and you do it again every month, at least 10 times a year. That's my goal, to do it 10 times a year, but technically you can do it every month. So you're going to get between 3.3 to 6% return on this trade. Now, some of the risks. Just like if you have real estate or any business, the value can go down. Real estate market could go down. Business value can go down. So the shares can go down to say 95 or 90. So if they go down to 90, for example, you're out 10 points. I'm sorry, you're at 7.38 points. If it goes down to 90, which is $7, right? So the value goes down, but you still get your income, you still get your premium, you can still pay your bills, you can still pay your car note, whatever that 325 paid you. And let's just say you're doing a trade over time, and over time you lost 7.38 points. We know that with 2.5 cover calls, getting 3.25 on the cover calls, you're going to make that money back. So it just has to deal with your income on the cover call versus your fluctuation in the stock price. I always have you select strong stocks that are going up in direction, ideally. And that way you get the benefit of the share growth plus the premium for the cover call. You really want both. But like I said, not always will the stock go up, so you might have some share growth loss. What you look at is over time, over the course of, let's say, 1 year, you might be getting your 3.3%. Let's say we do it 10 times. That's a 33% return. Okay? See how that works? So it's unlikely your stock's going to go down 33% over the year. It could. And the way I look at it dollar-wise is if you're getting 3.25 points a month, then that's like $32.50 per year. Because I just multiply it by 10. I give you a 2-month grace period because I don't want to make it hard. I want you to mess up and still do it good, right? So if your investment is $9,738, that's your business, okay, right there. That's your investment. And you're getting 32 points, $32.50 a year. That's $3,250 a year, okay? So in a way, you can think of it like this. You can think of it like you're getting $3,000 a year, $3,200 a year, which is your business. That's your business to do that. But also you can think of it like you're bringing your cost down from $9,700. I'm going to subtract $32.50. 8, 6, 8, 4, $6,488. So you invested $9,700. You brought in $3,200. Your cost has been reduced to $6,488. So in that way, you reduce your cost. So you can think of it two different ways. What most people do, what traders do, they take that $3,200 and they live off it. They pay bills. Obviously you want to have a bigger account, ideally. $100K, $500K, $1 million. Because then you're really banking those dollars. But you start small, you build up, right? So the risks are that your share price may go down, and then you're comparing your share loss to your income. But if you're on the cover call, you're 100% better off than the shareholder who just has the shares. Let's say you buy AMD stock or another stock, Apple, for example. You don't do cover calls. You're just holding the shares. Well, you're 100% better off with getting the cover call because you're bringing in the income. So you have an advantage over the average shareholder. There's one more risk I want to talk about, that if the stock shoots up, you don't get those profits, those returns, those share growth, because remember, you agreed to sell the stock in this case for 100 AMD because you wrote the 100 strike. So you can only get paid up to 100. Buy the shares at 97.38, goes to 100. You get 262 profit for the share growth, but not past 100. The stock could go to say 110, 120, 130, in which case the shareholder made 30% return right there on the share growth. But you did not. You just made about 2.5% return because you're agreeing to do the cover call, which is to sell it, write the cover call monthly. In this case, sell it at a strike 100. So that's one more risk is opportunity. It's an opportunity cost. You don't have the opportunity. If the stock shoots up in price, you don't get that share growth. You just get the strike you wrote the cover call for. Now, from experience, this is no big deal because guess what? Stocks don't always shoot up. Matter of fact, they rarely shoot up. If you're going to get paid monthly, 3% return, 3.3, that's way better because that's consistent money. You can pay your bills. You can live off your account. That's your business working, churning money, right? If the stock goes up to, let's say, 130, technically you won't get that 30% return, but you're still getting your 3% return a month. They can't take that away. What will happen is your stock will sell at 100. You can buy it back for 130 and write the next cover call for 130, let's say to 135. You can still do cover calls. It's just a matter of having to buy the shares back higher, which in this case, your cost is more, but you're still going to be able to write cover calls. So just keep that in mind. A cover call is a monthly trade. It's a great way to make money. Arguably, it's the best trade in the stock market, I think. I want to talk just briefly about the naked put. As you can see, left side calls, right side puts, right? In this case, if you sell a naked put, write this down, naked put. This trade's a little different. This trade is also long, which means we want the stock to go up, okay? But the naked put is where you, in this case, this is next month here, 95. If the shares are 97.38, I would write the 95 naked put. For one thing, or the 94. For one thing, you're getting here 3 by 305, bid and ask. In this case, the bid. So naked put 300 by 305. So you get paid the bid. So what happens is here is you're agreeing to take the stock should it go below 95. In this case, you're going to end up buying the stock for 95. Okay. But for that, you're going to get paid $3. And this is, again, a monthly trade. So $3, let's do the math. 3.00 divided by the share price. In this case, $95. Watch this. 3.157%. Let's just say 3.2%. 3.2% on the naked put NP. So again, we got a 3% right there. So whether you do a naked put or a cover call, they're about the same return. Naked puts actually do pay better if you think about the fact that when you do naked put, you don't have to buy the shares. So your maintenance, which is your investment cost, is less. Generally, they're going to, like, I know TD Ameritrade only holds 1/4 of the requirement for naked puts, which is on 100K, they'll hold 25K. On a 10K investment, they'll hold 2,500. But for 2,500, you're getting the full return, in this case, $3 or 3.2%. That's $300 on one contract. So that, and what you call that, you call it sell minus one naked put. In this case, 95 for October. That's what you call it. And on your account, it'll say -1. It'll have the option there. On the cover call, you're selling one, sell one. Remember, you have to buy 100 shares. Sell one cover call, CC. In this case, strike October 100. So the cover call, we're doing 100 strike. On naked put, we're doing 95 strike. You see that? Because the naked put situation is we're going to take those shares at 95 should the stock break below 95. But here's the funny thing about naked puts. If the stock price stays the same, 97, goes up 100, goes 102, goes back to 96, etc., fluctuates, but doesn't break below 95, we don't ever have to take those shares. We get our premium, 3%, 3.2%. We walk away. So in a sense, the naked put's better because we're putting less requirement, less investment up forward to do the trade. But there's something called cash cover puts where if you don't have the experience, they're gonna make you do cash puts, which is to say that they're gonna hold the money to buy the stock at 95. In which case, you're gonna need the whole cash. So, and not only that, if you're doing naked puts and you are cleared to do naked put trading, which is like they give you that after three or 4 years. You still have to have the cash to take the stock should it break below 95. So even though they require less money, you still kind of have to have the money there because if you get assigned, if the stock breaks below 95 in this case, you got to buy the shares at 95, in which case you need the cash. So I never try to push the envelope on that. It's still 3.2% return because I'm going by the share price. However, it's nice that you don't need all that cash to do the trade. For example, like we're doing monthly cover calls and monthly naked puts, but if you do a naked put and since you only need 25% up front to do the trade because you're not actually buying the shares, if you're cleared to do that, which I am, you can do like weekly cover calls with that money that's not being used. You can get weekly income, you see. So that cash being free gives you other opportunities. And while you're buying the shares on the cover call, you buy the shares outright. You own the shares. You're renting the option every month. On the naked put, you're not buying the shares. You're agreeing to buy the shares if the stock breaks below 95 in this case. And that's called naked put. And for that, you get the premium. So two sides of the same trade. Both great trades. Just write it down. Naked puts and cover calls. This is how you retire into the stock market. You got your $9,700. It'll be $9,500 for naked put. Okay, and you're bringing in either $325 on the cover call and $300 on the naked put. Now let's break that into 100K. Now we're doing 3,250 on the cover call and 3,000 on the naked put. Both just over 3% return. And let's get that to $1 million. If you had $1 million, you won't have it all in one stock. But there's other stocks. There's Netflix, there's NVDA, there's Apple, there's Google, there's Palo Alto. And I'll show you that Tesla. I'll show you these stocks pay probably, some of them pay more than 3%. Big stocks. In which case you're going to diversify your investment some, but still you're getting basically a similar return. And at $1 million, you're getting $32,500 a month on cover calls, or you're getting $30,000 on naked puts. And that's the kind of money you need to retire, pay your bills, and then some. To do the ends meet at 30 grand a month. You don't have $1 million. What have you been doing? Sell all the shit in your garage. Start saving like it's a religion. This is how the rich stay rich. How the rich get richer. They just do investments. They have people do this stuff for them all day, every month. you hear on the news that Apple went up $2. You're thinking, million shares, you get $2 million. But there's advanced traders that do these cover calls, naked puts, other trades, different trades, and they're just bringing in money like hand over fist every month, weekly, yearly, option trading, option writing. So I'm talking about it. I'm here to share with you every Monday night. Come join me. Right now we talked about AMD. I told you why the stock is good. We looked at the volume. We looked at the chart, 10-year chart. We looked at the return, the monthly return. Give me some likes, guys. I appreciate it. Hit the like. Hit the like button for me. Get some people in here. Follow. Give me a follow if you want to learn about stocks. Share if you have someplace to share this with. The big companies like, okay, I want to talk about market cap real quick. The market cap for AMD, I click on summary, 157 billion. So 157 billion. That's a good size. That's getting to the point where you're starting to play with the big boys. You're not a big boy, but you're pretty big. I mean, I would say my minimum investment, I like to have a market cap of 50 billion, because at 50 billion, you start coming into the big league. You start getting to be where you have enough infrastructure, enough investors to make it not so much a stable stock, but a proper investment. That kind of volume, that kind of value is around my minimum. I like about 50 million. I think Chipotle is at 50 million. I'm sorry, 50 billion. Let me look at Chipotle. Chipotle was around that price, that amount. CMG. Yeah, 51 billion market cap. So Chipotle is just getting in there to where it's getting big. The idea is that at 50 billion, it can grow, it can double, 100 billion, then the share price could double. 1,800 today, down 15. Don't be afraid to buy high price stocks. I say they're better. Gold is more expensive than silver. Silver is more expensive than lead. You're going to pay more for quality. Okay. The higher price stocks have proven themselves by going up and up. That's why they're better. These $5 stocks that you guys are investing, just stop that. You want to have standards. You want to have a criteria for your stock selection. One of those criteria is a nice high price share price. Let's say around 100. I mean, there are exceptions, but AMD is about 97, so that's right in there. We know Apple's 170. We know that Tesla is about 2. Let me pull up Tesla. Tesla was kind of going up and down. TSLA. Tesla's 246. Netflix, my favorite stock, NFLX. Came down a little bit, 384, but it's up 5 today. Netflix is 170 billion, and Netflix just passed Disney as the entertainment guru. If you consider that both Netflix and Disney are doing entertainment, Netflix is at 170 billion, and Disney it was right around 148 billion. So market cap wise, share value wise, Netflix outperformed and beat Disney for the number one entertainment company. So that means something. Okay. This is at 81 a share, down 24 cents. And the 3-year on Disney is going down. It's going down the tubes. It went from 180 to now it's 81. So it's having some trouble. On trend, if the 10-year chart, Disney was around 66. went to 180, and then now it's back down to 81. So the 10-year chart doesn't look great for Disney. It is making money from 66, like I said, to 180, but then down to 81. So still made money, but you want to make more money than that over 10 years. Like if I pull up Netflix, I'll show what I'd like to see. So Disney's like more of a stagnant position, whereas Netflix, we were at around $15 10 years ago, and now it's $3.84. Do the math. 384 divided by 15. 25 times. How would you like to 25 times return on your money in 10 years? Netflix. We can look at Tesla as a similar situation. Tesla 246. I can't even see the price here. I think it's $3. $3 10 years ago. So 246 divided by 3. 82 times your money, brah. 82 times your money. Tesla. So when I give you these stocks, I want you to write them down. I want you to consider them for your investment. Tesla is at, write this down here. Get a journal. Write this stuff down. 246.99 plus 211. Let's review Netflix. Netflix is NFLX 384 and 80 cents plus 4.99. We talked about AMD. AMD is AMD 97.38 plus 118. And we talked about what else? Can we also cover Chipotle? Chipotle, CMG. I told you Chipotle can double, so it could go to 3,600 a share. Like, look, Chipotle is 1,800 today, September 2023. If it's 3,600 in 5 years, you heard it from me first, okay? 1859 down 1589. And let's do one more. Disney I didn't like because it was in a downtrend. Netflix took over for entertainment guru. Let's just do Apple because Apple is the big head honcho. Apple AAPL 176.08 plus 129. Let me give you a dividend stock, PM Philip Morris. Why? Because you don't want to have all your stocks in technology. You want to have some dividend stocks. Consumable, PM Philip Morris International cigarettes, 93.72. This one came down a little bit. Hey guys, I appreciate you. Give me some likes. Get people in here. Help me get some people in here. Okay, Philip Morris is 93.72. This one's down 121. So this one has a little bit of a, look at the 10-year chart. So this is, so when I say I want you to make money in 10 years, that is generally always true. However, like Philip Morris, I have here $90 10 years ago, and now it's $93. But guess what? They're paying a dividend, and they're paying a hefty dividend of 5.48% dividend. 5.48%. And that equates to $5.20 a year on a share price of $93.72. So the dividends are good because, you know, there's no trading. You just hold on to the shares. You just hold on to the shares and you get the dividend every quarter. In this case, 5.48%. 40% per year. On $1 million, that's 54,800, and that's why that's important, because you can live on that money, and you do pay taxes on dividends. But unlike a paycheck from your job, notice they take out taxes. They take out Social Security taxes. They take out federal taxes out of your check. But on dividends, they give you the whole amount. They give you the whole amount, and you don't have to really worry about taxes until the following year. So by that time, you can have write-offs. You can have your costs deducted, and then you can just pay your taxes on the portion that you really earned after all your write-offs. So that's why business money, investment money is better, because on the cover calls also, you're going to get full return on the cover calls. And when you go to pay taxes, you just see your tax guy. If you owe X dollars, then you'll pay that amount, and you can get your write-offs. So that's why it's better. That's why investments are better, because you don't gotta pay taxes right off the bat. You're gonna have a chance to reinvest that money until next year, and then pay the taxes tax time. That's why businesses are better, always better than a paycheck. Some of you guys don't have nothing. You're starting from scratch. So think about. I talked about Skechers last week. SKX. Let's pull up Skechers. Think about a stock that's, in this case, cheaper. 48.05. 48.05. Down, up 40 cents. So Skechers, to buy 100 shares, is $4,805. Okay. And for that investment, you can do the cover call on that. Let's put the option chain. Hey guys, give me some likes. Get some people in here. On Skechers. And let's look at the cover call. Now, I know it's not going to pay what AMD pays, because it's not as robust, but it's still going to pay you money. 47.63 share price. If I look at let's say the 49 strike, Skechers. So you buy 100 shares at 48.05. So it costs you $4,800. You write CC cover call for October 49, and that pays 130 by 140. 130 by 140, which is $130. Okay, so your $4,800 investment pays $130 a month on the cover call. That's Skechers, and we know that's a shoe company. We know that's a product company. And let's do the math on that. 1.3 divided by share price. That's the premium. That's what they tell me on the options chain. Divided by share price of 48.05 equals 2.7% return. So 2.7% return on Skechers. And I just brought that up because it's a stock I like, and it's cheaper. It's less of an investment, lower investment, lower entry, right? You may not have 10K, you have 5K, but get some money together. Like, get a loan or something, guys. All right. And if we did that trade 10 times a year, you can do it 12 times, but I'm making it easy for you. You can slip up twice. And you're going to get 27% a year return on this one stock, Skechers. So, like, you can do some diversification. You can have some Skechers, some AMD, some Netflix. You have a big account, you're going to have different investments. But the idea is you're having the shares, you're renting out the shares to the public. You're getting a monthly return. Similar to if you had an apartment owner that has apartments, they rent out the rooms. A shareholder has the shares and creates the option, rents out the stock to get paid on the option, in this case the cover call, for monthly income. Same idea. How like my analogy? Questions? Give me some likes. Give me some comments. Give me some follows, guys. What's up? I don't have many comments right now. I'm going to be out here every Monday teaching you guys how to retire into the stock market. Godric here, your stock market mentor. We covered AMD. We covered Skechers. We talked about Tesla, Netflix, Chipotle, Apple, Philip Morris. 1, 2, 3, 4, 5, 6, 7. Let's do one more. Let's do 8 stocks today. 1, 2, 3, 4, 5, 6, 7, 8. Starbucks, SBUX. We know Starbucks is a consumable. They do coffee, and they have awesome products. They have drive-through. Starbucks did great in the COVID because they had drive-through, so weren't really affected by the COVID. In other words, how do we say it? Pandemic proof. All right, symbol SBUX. And I just like to round it off with some consumable stocks. 92.74, down 94 cents. If I click on fundamentals, Starbucks is a roaster, marketer, and retailer of specialty coffee with operations in approximately 83 markets. That's 83 countries. It has over 35,000 company operated and licensed stores. Summary, market cap, 106 billion. You see there? It's right at that place to where it started to compete with the big boys. 100 billion, 50 billion. And at 100 billion, I'll tell you that Starbucks could double in size. And in that case, the share price, go ahead. The share price will double. It could double. So you're right there at that, like, it's not a magic number, but it's just like 100 billion is like a nice, it's not too big, not too small. What else? Let's look at the 10-year chart on Starbucks. I love 10-year charts. I had here $42 about 10 years ago. So it more than doubled. And that's, I mean, if your stock is going to double, more than double, triple, it was 120 back in, let's say, September 2021. It was 120. So in that case, it tripled from 10 years ago. So that's the kind of growth I like to see. I like to see doubling, tripling, quadrupling, times 10, times 20, times 50. That's what I'd like to see on the 10-year chart. So Starbucks is good. So we covered 8 stocks: Tesla, Netflix, AMD, Advanced Micro Devices, Chipotle, Apple, Philip Morris, Skechers, and Starbucks. We're doing it good, guys. We have, solid criteria. We got cover calls for monthly income. We got naked puts. We touched on dividends. Dividends, again, is great because you get paid while you sleep. You don't got to trade. You don't got to do cover calls. You just hold the shares, get the dividends every quarter. Bam, bam, bam. Like clockwork. Any questions for me before we wrap up? We can wrap up pretty soon. Give me some likes before you go. Give me some comments in here. I'm looking for comments. I'm looking for questions. Ask your mentor. I'm here every Monday night, but I'm here tonight. Talk to me. Send me a message. I'll pull up your stock. If you want me to pull up your stock, I'll do that. But don't get offended if I tell you it's trash. I'm gonna tell you the truth. Don't give me a penny stock. Don't waste your time. I like quality companies, higher price, share price, $100 a share, $200 a share. I like Netflix. $400. Oh, NVIDIA. Let's do NVIDIA, then we'll be done. NVIDIA has joined the ranks of the $1 trillion market cap. They do graphics cards and computers. NVDA. And the share price, let's look it up. NVIDIA. Symbol NVDA. is 422. $422.22. Up $6 today, 612. And like on the 10, oh, let's look at the summary. Market cap 1 trillion. That's 1,000 billion, guys. No joke. It joined the ranks of Apple, Google, Amazon. Those are all $1 trillion companies. So it's pretty damn big. And it's like the new kid in the block. If I want to do if you want to look at the chart, it was, I can't even see it, but it looks like around $4 10 years ago. So 100-fold return. Dude, this is how you get rich in the stock market. You have a stock. Even if you're doing cover calls, you'll probably get most of that share growth. You're gonna get cover call money, premiums. Over 10 years, it's just like, how do you say, exponential growth. So let's top it off with NVIDIA, number 9. And we're going to review this next week, but send me your messages. I will review your stock for you. I'll tell you what I think. I have different criteria. I like to have volume. I like to have 10-year chart going up. I like to have PE. PE means they make profit. If your PE is a dash or a 0, that means they're losing money. If your PE is a positive, that means they're making profit. I like to have high price shares. I like to have a cover call return of, let's say, 3 to 4% to 5% a month. See how that works? That's 50% a year if you can do it 10 times. Look, get one of these stocks. Get 100 shares. Start doing cover calls. Send me a question. If you have questions, I'll guide you through it, dude. You don't got to pay me any money. I'll show you how to do it. And there's nothing stopping you. It's just learn just the knowledge. They don't teach this in school. You can't learn this at a seminar. Not really. They don't really want to teach you that. They want to do that. They want to keep that knowledge for themselves back at BlackRock behind closed doors doing their own trades. They don't want everyone to learn this. So people like me, you want to get a mentor that teaches it. All right. Final questions? Any comments? All right, guys. I have a guest request, but let's see if he's still here. We're going to wrap up right now. Atilio, you here, player? We're about to wrap up. Talk to me. You have any stocks for me? Any stocks for me? Give me a message. Oh man, dude, thank you. That's what I'm here for. We covered 9 stocks today. I don't know what time you came in. I'm gonna be here every Monday night. Just killing it for you. Just doing the cover calls, covering the option trades, reviewing stock market. Right now I think the market's good. Probably we won't have a correction. I don't see a correction really. It's kind of strong right now. I mean, Trump will probably win. That's probably going to be really good for the market. But regardless of that, the Fortune 500 companies employ 30 million employees, bro. It's a strong business right now. I don't see issues right now. It's a good time for investment. Any questions? Got 5 people in here. Okay, we're going to end, man. We're going to end. Send me messages. I'll try to help whatever I can. Godric out.